Welcome to this deep dive into Hyperliquid, the Layer 1 blockchain that's making waves in the decentralized perpetuals market. In under 10 minutes, we're unpacking everything from tokenomics to team structure, from GitHub data to legal risks. Whether you're a DeFi veteran or a curious investor, this breakdown will equip you with the facts behind the hype. Let's begin with the team behind Hyperliquid. The core developers come from elite academic and quantitative trading backgrounds. Alumni of Harvard, MIT and Caltech, plus stints at firms like Citadel, Neuro, Hudson River Trading and Airtable. The founding group reflects high technical and financial competence. While the team remains pseudonymous, two members, Jeff and Ilian Sink, have developed public reputations within the Hyperliquid community. What's notable is the absence of venture capital funding, a rarity in this space. The protocol claims to be community-funded and community-led from day one. Hyperliquid launched without traditional VC backers. Instead, its token distribution was executed through a combination of user airdrops, community incentives, and fair market pricing. This has proven successful. Upon launch, the Hype token surged from under $4 to over $26 in just days, sparking attention across crypto Twitter and large investment channels. One notable investor reportedly deployed over $10 million in USDC into the token on-chain, reflecting strong whale interest. Despite the volatility that followed, Hype cemented its place in the top market cap rankings without a centralized listing or external push. From a development perspective, Hyperliquid maintains a moderate but consistent presence. It averages roughly 2 commits per week across its core repositories and involves around a dozen active contributors per month. That might seem light compared to monolithic projects like Ethereum or Cosmos, but for a focused perpetuals protocol with custom Layer 1 architecture, it reflects steady iteration. The codebase includes the custom HyperBFT consensus implementation and its HyperEVM, which are maintained under open, transparent licenses. Tokenomics is where Hyperliquid distinguishes itself. The total supply of Hype is capped at 1 billion tokens, with around 334 million currently in circulation. No portion of the supply was allocated to VCs, insiders, or exchanges. All distributions happen through public means, including user airdrops and liquidity mining. Most notably, 97% of the protocol's trading fee revenue is allocated to Hype buybacks and burns. This creates constant deflationary pressure whenever trading volume is high. It also aligns user incentives. If protocol activity increases, token scarcity increases. A small remaining portion of fees funds operations and security. Hyperliquid's white paper, while brief, lays out a compelling architectural model. At its core is a custom Layer 1 chain built on a modified hot stuff-based consensus called HyperBFT. This allows for extremely fast finality, sub-second, without sacrificing security. Unlike rollups or hybrid systems, Hyperliquid settles every trade natively on its own chain. That gives it full control over the matching engine, Oracle integration, and final settlement. The white paper also emphasizes a hybrid matching model. Order books are maintained off-chain for speed, but all fills and positions are enforced on-chain for security. From a data standpoint, the numbers are impressive. Hyperliquid's protocol currently manages over $1.75 billion in total value locked. It processes roughly $400 million in daily DEX volume, and its perpetual futures trading clocks in at around $7.5 billion daily, rivaling centralized exchanges. These volumes generate around $2 million in fees per day, nearly all of which go into Hype token buybacks. The project ranks top 10 across several DeFiLlama categories and sits among the top 5 in open interest for perpetuals. Now, is it financially sustainable? The answer depends on whether its current volumes are sticky or speculative. So far, volumes have been remarkably resilient, but we've seen dips. For example, when TVL dropped from over $3 billion to around $1.9 billion in early 2025, Hype's price and daily volume fell too. This ties the project's valuation directly to market usage. With 97% of fees used for buybacks, there's little left for treasury accumulation, meaning sustained trading interest is essential to keep the lights on and the tokenomics working. On the regulatory front, Hyperliquid is threading a narrow path. It recently submitted comment letters to US regulators, including the CFTC, outlining its positions on decentralized derivative trading and 24/7 markets. This proactive engagement suggests awareness of legal scrutiny. However, the project does fall into a high-risk zone. As a decentralized platform offering high-leverage derivatives, it could face issues if global regulators crack down. Its lack of KYC and open participation structure may also invite pressure, especially in jurisdictions like the US, where perpetuals are heavily regulated. Looking at roadmap delivery, Hyperliquid has hit most of its milestones. The chain is live, Hyper-EVM is integrated, spot trading is expanding, and the tokenomics are in place. While not all features have rolled out, like full permissionless liquidity and DAO-driven governance, progress has been steady. Compared to many projects that delay or scrap roadmaps, Hyperliquid appears consistent and relatively transparent. So what's next? Upcoming features include the expansion of supported spot markets, the introduction of community governance, and infrastructure improvements for liquidity providers. There's also talk of integrations with Bitcoin Layer 2 protocols, potentially expanding collateral types. Most importantly, they aim to enable permissionless listings, a major step toward full decentralization. The community around Hype has grown rapidly. It's no surprise. The token's price exploded 300% over just 2 months and reached a peak of $45 before cooling off. The protocol now has over $9 billion in perpetual open interest, putting it ahead of names like Dogecoin and XRP. Its Discord and Telegram groups are active, and governance discussion forums are starting to mature. That said, the project still relies on strong whale support and concentrated holders, which can be both a blessing and a risk. Despite the upside, risks remain. First, volatility. The token is highly sensitive to shifts in protocol volume. If traders leave, price drops can be rapid. Second, centralization. The validator set is relatively small, around 21 nodes, which could lead to governance bottlenecks. Third, regulatory exposure. Being a derivatives platform without strict KYC can draw scrutiny. And lastly, sentiment. Some see Hype as a meme coin wrapped in serious tech. Whether the narrative holds long-term will depend on delivery and adoption. That is the end of this 10-minute deep dive. If you want an unbiased review or deep dive into any project, leave a request in the comments below. If you found the content informative and useful, please like and subscribe. We appreciate you watching. Till next time, thanks again.